Hey, Emmett Dempsey, Treasure Coast Mortgage. Welcome back to the channel. Today's video is going to be about appraisal gaps and dealing with low appraisals, as well as an appraisal gap strategy using mortgage insurance that can help save you some money. I'm going to go into a detailed example here in a minute. If you're a home buyer or a realtor, you know it's pretty crazy out there right now. You might be feeling a lot like this lady.
Okay, a lot of sellers are accepting over asking. Over asking, what is that? Bidding above the sale price. We used to bid like 50 grand below the sale price. Oh, those days are long gone. So what are you comfortable with? Maybe 5,000 over asking? More. 7? What, 10? Is that the best we can do? But I haven't even seen it. What did he say? They have 72 offers and the lowest is 50,000 over asking. $50,000? Are you kidding me?
Yeah, that was a Holder and his family. They have a pretty cool YouTube channel. Go ahead and check out a link to that video down below in the description. But yeah, how do we bridge an appraisal gap? Of course, that's what happens when you have the sales price up here, appraised value down here. How do you bridge that appraisal gap if you're not a tech billionaire or made of cash? Basically, we use mortgage insurance in order to help you out. And many times it's very minimal impact. I'm going to show you a detailed example right here. Let's go and take a look. Okay, appraisal gap strategy. All right, so first of all, this is a mortgage coach total cost analysis. This is how I present all my options to my clients. I'm going to show you exactly what the dollars and cents are of an appraisal gap, just so you can see it in black and white. Here's an example of a $400,000 purchase price, and what happens on different appraised value levels for your appraisal gap. Here's the first example of what if it was normal. Okay, sales price came in at 400, you put down 20% down. And then here's your payment, and here's your cash to close. Okay, and I assumed tax and insurance of $150 for hazard insurance, $275 for taxes, which is a good average. Of course, it could be higher or lower depending on what you're buying, but this is an example. Okay, so here's that first strategy: $1,773 payment, $88,000 and change cash to close. Okay, here's two examples of appraisal value coming at $375 and $350. Okay, so comes in at $375, you're paying $108,000. $350 pays $127. So it's not a direct $25,000 because you can finance a large portion of it. So it's scalable to how much you're financing. But still, it's more money out of pocket than you might have budgeted for, or that you could even pay. So how do you compete with cash buyers? You know, when you're bidding on homes, knowing you only have so many dollars in the bank account in order to compete, and the answer is using mortgage insurance. Okay, so that's and what I'm going to do, I'm going to use this extreme example of $50,000 appraisal gap and how you can even compete still. All right. So here's an example. Here's your first one, the 400,000, 20% down example, 1773, 88,000. Okay. The first one is monthly mortgage insurance going to 90%. All right. So you can still, finance 315. Okay. Your cash to close goes to 94,000. It's better than the 127 and change. Into 94,000, so that saves you quite a bit of money, and it keeps your payment relatively the same as that, than what you're anticipating, 17,000 and change, 1,700 and change rather, so that's the first strategy. So it's monthly mortgage insurance that'll fall away, and of course, I know a lot of folks who put down 20%. They're so anti-mortgage insurance, but you're using mortgage insurance to help save you some cash, which ultimately is king. These next two examples are what's called LPMI, or lender paid mortgage insurance, or you might have heard single premium. Basically, you're buying out your mortgage insurance up front, which may or may not make sense depending on your goals for what you're going to do with the house. All right, so this first one is if you just financed it in your rate. Okay, you just raise your rate to 3.361. Raises your payment a little bit, keeps your cash to close. Similar to the monthly. This next one is if you buy it down, keep it at 2.99. It raises your cash to close to 97, but it keeps your payment at 1752. This is the lowest payment scenario out of all three of these. You're just buying it out, keeping it at 299, and keeping it that way. So because you can still finance more. So that's kind of using mortgage insurance in order to compete with cash buyers and make confident offers that you can still win the house. Okay, welcome back. Hopefully that was an informative, detailed example about using mortgage insurance to help bridge appraisal gaps. Here's some more videos on my channel you might find useful. Of course, if you need a buy, sell, refi, definitely give me a call. Go to DempseyMortgage.com. Thank you so much for watching, and I'll see you on the next one.